going to cover a very basic summary of financial statements. There's three of them we're going to talk about, which are the main components of every single business that's out there. Income statement, balance sheet, and the statement of cash flows as you go through. You'll see them listed in corporate reports. These are the three main ones. Everybody does them. Here is the fundamental accounting equation that you must know. It is the formula for the balance sheet. Assets equals liabilities and owner's equity. Assets equals liabilities plus owner's equities. In other words, we use double entry bookkeeping methods as you go through, and you sit down and you enter your assets, and by the time you're all done, it should equal the same amount of money as your liabilities and owner's equity in the process. So we balance it out as you go through. Everybody does it. Every single business, you have to have this type of thing. You may employ a bookkeeper to create these items for you, or an accountant in the process you go through. Here is some of the basic statements that you have to know, and really about the aspect of assets. Assets, they're economic resources, things that are valued, things that you own as you go through. Liquidity is about how fast you can get rid of it and get cash money for it. So current assets, they can be converted into cash within a year. Fixed assets take a longer time. They're like a building typically, and you may have to spend a year and a half trying to sell the building to get cash out of it. And then you have some intangible assets like a trademark, a copyright, as you go through the patent. Those are things that are mental in the process, and you often don't touch them. They're often not things that you can hold and touch as you go through. Those are also assets. We have current, which are 1 year or less that we can get rid of and turn into cash, your fixed assets, and then intangible as you go through. On the other side of the balance sheet is your liabilities. This would be accounts payable, money that you owe people, or notes payable, or bonds payable. Accounts payable usually is short-term, notes is mid-term, and bonds is long-term as you go through. Owner's equity is a number that you sit down between the assets and the liability. When they don't balance, you sit down, whatever numbers left over is your owner's equity as you go through. That's the amount that belongs to the owner minus the liabilities owned by the business. If your business is not doing well, you're going to have a smaller owner's equity because you're pumping more money into it. But as it grows, you'll have the owner's equity grow in the process. Sometimes you keep the money, instead of giving it to the owner, you actually retain it in the company and use it to expand as you go through. So on this section, the balance sheet is a snapshot of one moment in time as you go through. Keep in mind that the main formula for the balance sheet is assets equals liabilities and owner's equity. Assets are things you own. Liabilities are things that you owe. Owner's equity is the thing that's left over, and liquidity is about how fast you can convert it all into cash. And also retained earnings is that when you keep the money in the company and don't disperse it as a dividend or a profit to the owners, you retain it. We call it retaining earnings in the company as you go through. Take care.